Tomorrow morning at 8 a.m. Central Time, Harley-Davidson will release their fourth quarter and full year 2025 financial results, and the numbers are going to be catastrophic. Wall Street analysts are bracing for disaster, dealers are terrified, and Harley Corporate is scrambling to spin the narrative before investors see the actual data. We know what's coming because the warning signs have been flashing red all year. Q3 global retail sales down 6%, tariff cost hitting $175 million annually. 200 dealers closing their doors. Inventory stacked so high that 2024 models are still rotting on showroom floors in February 2026. Morgan Stanley downgraded Harley to underweight with a $21 price target, calling them the worst-positioned company in their entire leisure sector coverage. Tomorrow's earnings call will confirm what we've been telling you for months. Harley-Davidson is collapsing in real time, and no amount of corporate spin can hide it anymore. If you want to know exactly what tomorrow's numbers will reveal, why they'll be worse than analysts expect, and what it means for the future of America's most iconic motorcycle brand, hit like and subscribe, because we're about to walk through the financial carnage that Harley desperately doesn't want you to understand. The earnings release drops at 7 a.m. Central Time tomorrow, February 10th, 2026, before markets open. The conference call with senior management starts at 8 a.m. Central. By 9 a.m., we'll have the complete picture of just how badly 2025 went for Harley-Davidson. And based on everything we know from Q3 results, industry data, dealer reports, and analyst expectations, Q4 is going to confirm the death spiral. Let's start with what we already know from Q3 to set the baseline for tomorrow's disaster. Q3 2025 revenue increased 17% to $475 million, which sounds good until you understand why. The revenue increase came almost entirely from a one-time financial services transaction, not from selling motorcycles. Global retail motorcycle sales, the actual number of bikes sold to consumers, declined 6% year over year. North America, Harley's core market, down 5%. EMEA, down 17%. Asia Pacific, down 3%. Only Latin America showed growth at 16%, a tiny market that doesn't move the needle. The critical number everyone ignored while celebrating the revenue beat was that 6% global retail sales decline. That's real customers not buying motorcycles. That's dealer showrooms full of inventory nobody wants. That's the structural collapse of demand that no financial engineering can fix. And Q4 is going to be worse, significantly worse, because all the negative trends from Q3 accelerated into year-end. Here's why we know Q4 will be catastrophic. First, the tariff impact exploded in the second half of 2025. Harley reported $27 million in tariff costs in Q3 alone and $45 million year-to-date through September. That means they faced $27 million in new tariff costs just in July, August, and September. In Q4, those costs continued and potentially accelerated because Trump's reciprocal tariffs that launched in April 2025 didn't get modified for motorcycles in the November adjustments. Harley is eating a 10% universal tariff plus a 25% motorcycle-specific tariff on imported components, creating a combined 35% plus tax burden on significant portions of their supply chain. Remember, even Harleys assembled in America use 30 to 40% foreign-sourced parts. Every bike Harley builds carries hundreds or thousands of dollars in tariff costs that either destroy their margins or get passed to consumers in higher prices that kill demand further. Harley's full-year tariff cost guidance was $130 to $175 million annually. Through Q3, they'd hit $45 million. That means Q4 alone probably brought another $40 to $60 million in tariff costs, potentially more if imports spiked before year-end to build inventory for 2026. These tariff costs go straight to the bottom line as reduced profitability. They can't be avoided, they can't be engineered away, and they're not temporary. As long as Trump's tariff regime continues, Harley bleeds millions every quarter, while competitors with different supply chains gain cost advantages. Second, dealer inventory remained dangerously elevated throughout Q4, despite Harley's claimed efforts to reduce it. Harley reported 52,000 units of global dealer inventory at the end of Q3, down 13% from Q3 2024, but still representing months of supply at current sales rates. But here's what Harley didn't tell you in that carefully spun statistic. The 13% reduction came almost entirely from dealers going out of business and sending their inventory back to Harley or selling it at auction for pennies on the dollar, not from healthy retail sales clearing inventory naturally. When a dealer closes, their bikes don't just disappear. They get redistributed to surviving dealers who don't want them, sold through liquidation channels at massive losses, or end up back with Harley eating the carrying costs. The reduction in dealer inventory units isn't a sign of health, it's a sign of dealer network collapse removing selling locations. And the inventory that remains on dealer floors is stale, outdated, and heavily skewed toward models nobody wants. Multiple dealers across the country reported in late 2024 and early 2025 that their showrooms were completely packed with 2024 model year bikes that they couldn't move, even with aggressive discounting. One dealer in California reported 87 brand new 2024 models still in inventory in January 2025, with 0 2025 models because there was literally no physical space to receive new inventory. Another dealer reported that Harley kept shipping 2025 models in late 2024, even though they had 2024 stacked everywhere and explicitly told Harley to stop shipping. Harley's dealer agreements force dealers to accept allocated inventory or risk losing their franchise, creating the perverse situation where dealers are suffocating under inventory they can't sell, while Harley ships more to protect corporate revenue numbers. This inventory crisis directly impacts Q4 results in multiple ways. First, when dealers finally sell stale inventory, it's typically at significant discounts that reduce or eliminate dealer profitability, and that require Harley Corporate to provide incentive money or take back allowances that reduce corporate margins. Second, high dealer inventory levels suppress new production and shipments because there's nowhere to send bikes, which reduces Harley's manufacturing volume and increases per-unit costs due to underutilized production capacity. Third, bloated inventory ties up dealer capital in floor plan financing at 8 to 12% interest rates, which costs dealers hundreds of thousands per month and pushes more toward bankruptcy, which creates write-offs and bad debts for Harley's finance arm. The inventory crisis is a multi-dimensional disaster that shows up across Harley's entire P&L. Third, the pricing environment collapsed throughout late 2025 as desperate dealers competed on price to move inventory and generate cash flow. During the COVID boom, dealers sold at MSRP or above with healthy margins. Today, dealers are selling at invoice or below just to reduce floor plan interest expenses and free up cash to pay bills. We documented this extensively in our dealer crisis video. Harley's revenue per unit shipped has likely declined because they're providing more dealer incentives, more customer financing subsidies, and more marketing support to move bikes that used to sell themselves. When you see revenue numbers tomorrow, divide by unit shipments to get revenue per unit and compare that to prior periods. The revenue per unit decline will tell you how much pricing power Harley has lost, and it's going to be ugly. Fourth, the 2026 model year launch in January. 2026 was met with overwhelming indifference by both dealers and consumers, suggesting that Q4 2025 sales were weak as buyers waited to see the new models. Then Q1 2026 will also be weak because the new models didn't excite anyone. Harley's Chapter 2 launch event on January 14th, 2026 revealed 13 new or updated models for 2026, including the rebranding of Ultra Limited to Street Glide Limited, new paint schemes, minor mechanical updates, and a handful of genuine changes. The market response was a collective yawn. Dealers reported minimal pre-orders. Enthusiast forums and social media showed more criticism than enthusiasm. Pricing increased across the board, with base models seeing $1,000 plus increases and premium models like the 2026 Street Glide Limited starting at $33,000, $3,000 more than many buyers can or will pay in this economic environment. The new Milwaukee 8 121 engine in CVO models provides more displacement, but not enough additional power to justify $50,000 plus price tags when competitors offer more performance for less money. The Pan America continues to be Harley's only genuinely competitive product, receiving positive reviews and decent sales, but it's a tiny percentage of Harley's volume and doesn't appeal to Harley's traditional cruiser customer base. The weak 2026 lineup means Q4 2025 was hurt by buyers waiting, and Q1 2026 will be hurt by buyers being disappointed, creating a valley of weak sales spanning the model year transition. Fifth, the dealer network collapse accelerated in Q4 and will show up in Harley's results through multiple channels. We documented that approximately 200 dealers are expected to close in 2026, but many of those closures were announced or occurred in Q4 2025 as dealers exhausted their cash reserves and gave up. Los Angeles. Harley-Davidson closed October 31st, 2024. NYC Harley-Davidson closed September 2024. Taboo. Harley-Davidson in Louisiana closed October 16th, 2024. Miracle City. Harley-Davidson in Florida closed September 1st, 2024. Additional closures continued through Q4 2025, each one representing write-offs for Harley's finance arm, inventory that has to be liquidated at a loss, service customers who lose support, and further weakening of brand presence in those markets. When a dealer closes, Harley typically has to buy back inventory at wholesale prices and eat the loss when that inventory gets sold through other channels at discounted prices. They have to write off unpaid receivables. They lose future parts and accessory revenue from that location, and they damage customer relationships in that market because owners lose convenient service and parts access. The financial impact of dealer closures doesn't show up as one line item. It's diffused across inventory write-downs, bad debt expense, reduced revenue, and increased costs to support orphaned customers. Analysts who don't understand the operational complexity of dealer closures underestimate how much they cost Harley, which means tomorrow's results could include charges or impacts that surprise the street. Now, let's talk about what Wall Street is expecting and why those expectations are probably still too optimistic. Analyst consensus estimates for Q4 will be published tomorrow before the results release, but based on full year 2025 expectations and Q1 to Q3 results, we can back into Q4 expectations. For full year 2025, analysts initially expected relatively flat earnings before Harley withdrew guidance in May 2025, specifically citing tariff uncertainty. The guidance withdrawal was a huge red flag that analysts largely ignored. When a company pulls guidance, it's almost always because actual results are tracking significantly worse than the guidance range, and they want to avoid officially missing and reset expectations lower without the embarrassment of a formal downward revision. Harley's stated reason for withdrawing guidance was tariff uncertainty, which is technically true but incomplete. The real reason was that retail sales were collapsing faster than they anticipated. Dealer inventory wasn't clearing. Tariff costs were exceeding internal estimates, and they had no visibility into whether things would stabilize or continue deteriorating. By pulling guidance, they bought themselves flexibility to deliver bad results without officially missing guidance they'd committed to. Tomorrow we'll see exactly how bad it got. Morgan Stanley's downgrade to underweight with a $21 price target in December 2025 gives us insight into what sophisticated analysts think. Morgan Stanley called Harley the worst-positioned company in their leisure sector coverage due to weak trends, limited pricing power, and increasing competition. That's devastating language from a major investment bank. They're not saying Harley is temporarily struggling. They're saying Harley is fundamentally impaired relative to all comparable companies. For Morgan Stanley to go underweight, they must believe that even after recent stock price declines, Harley still has significant downside because the business deterioration isn't fully priced in. D.A. Davidson maintained a buy rating but lowered their price target from $34 to $30, showing even bulls are getting nervous. Their thesis is that new CEO stars will eventually stabilize the business through dealer relationship improvements and inventory rationalization. But eventually doesn't help Q4 2025 results, which will reflect the ongoing crisis. The most optimistic bulls are hoping for a bottom and eventual recovery, not defending current business performance. Fair value estimates from financial modeling suggest Harley is worth around $27.50, roughly 32% above current trading prices, near $21. But those fair value estimates assume revenue declines moderate to around 6% annually and that profitability stabilizes. If tomorrow's Q4 results show revenue declines accelerating or margins compressing more than expected, those fair value estimates will get marked down significantly. The stock could easily test $18 to $20 if Q4 confirms deterioration rather than stabilization. Let's talk about what specific numbers to watch tomorrow and what they'll tell us about Harley's actual condition. First, global retail unit sales for Q4 and full year 2025. This is the number of motorcycles actually sold to consumers, not shipped to dealers. If Q4 shows declines worse than the 6% decline in Q3, that confirms the deterioration is accelerating. If full year 2025 retail sales declined more than 7 to 10%, that's catastrophic because it means they've lost close to 100,000 unit sales since the peak, and the customer base is shrinking faster than Harley can adapt. Watch the geographic breakdown. If North America declined more than 5%, that's death, because North America is 70+% of Harley's volume. If EMEA declined more than 20%, that market is essentially lost. If Asia Pacific declined significantly, Harley's growth markets aren't growing. Second, dealer inventory units globally and in North America specifically. If dealer inventory is still above 48 to 50,000 units globally, nothing improved despite a year of claimed focus on inventory reduction. If North American dealer inventory is above 35,000 units, dealers are still drowning. Remember, healthy inventory levels for Harley used to be around 90 to 100 days of supply. At current sales rates around 200,000 units annually. That's about 45 to 50,000 units of healthy global inventory. Anything materially above that is excess that costs Harley and dealers money and suppresses future shipments. Third, HDMC revenue and margin. Harley-Davidson Motor Company revenue and operating margin will show you how the core motorcycle business performed, stripped of financial services noise. If HDMC revenue declined year over year despite Harley claiming shipment growth, that means revenue per unit declined from pricing pressure and incentives. If HDMC operating margin compressed, that means tariffs, incentives, and manufacturing deleverage are destroying profitability. Watch for operating margin below 15%, which would indicate serious structural problems. Fourth, financial results. Harley-Davidson. Financial services results will be complicated because Harley sold a significant portion of HDFS in 2025 to generate cash, but whatever HDFS results Harley still reports will show you retail, credit quality, and whether customers are struggling. If retail credit losses increased above 3.5% annualized, customers are defaulting at rates that indicate financial stress. If new originations decline significantly, fewer customers are financing bikes, which means sales are either cash purchases by affluent buyers who don't need financing, or sales volumes are worse than reported because customers can't qualify for financing. Fifth, cash flow and liquidity. Free cash flow and liquidity will tell you whether Harley is burning cash operationally or generating cash despite weak sales. If free cash flow was negative in Q4 or full year 2025, Harley is consuming cash to operate the business, which is unsustainable without asset sales or borrowing. If liquidity declined despite the AS transaction that generated over $1 billion in cash, that means they're burning through cash faster than they're generating it. Watch for total liquidity below $2 billion or free cash flow negative by more than $100 million, either of which would indicate financial stress. Sixth, 2026 guidance or lack thereof. Will Harley provide 2026 guidance tomorrow, or will they continue hiding behind tariff uncertainty and refuse to guide? If they provide guidance, what do the numbers look like? If they're guiding for continued revenue declines and margin pressure, that's an admission the crisis continues. If they guide for stabilization or improvement, does anyone believe them given 2025 results? If they refuse to provide guidance again, that's an admission they have no visibility and no confidence in the business stabilizing. No guidance after an entire year to assess the situation would be devastating. Seventh, management tone and language during the conference call. Listen carefully to how management discusses the business beyond the scripted prepared remarks. Are they defensive and making excuses about tariffs, weather, economic conditions, and other external factors? That indicates they don't have real solutions and are just hoping conditions improve externally. Are they taking accountability for operational issues and outlining specific actions to improve dealer profitability and retail demand? That would indicate they understand the problems and have a plan, though execution remains uncertain. Are they optimistic about 2026 based on the new model launches and dealer initiatives? Or are they cautious and hedging expectations? The Q&A session will be critical. When analysts ask about dealer closures, listen to whether management acknowledges the crisis or downplays it as natural consolidation. When analysts ask about pricing and incentives, listen to whether they admit pricing power is gone or claim they're maintaining discipline. When analysts ask about market share losses to competitors like Indian, listen to whether they acknowledge the threat or dismiss it as irrelevant. The candor or evasiveness of management responses will tell you whether they truly understand the situation or are still in denial. Here's what I'm personally expecting tomorrow based on all available data. Q4 global retail sales will decline 8 to 10% year over year, worse than Q3's 6% decline, confirming acceleration of the downturn. Full year 2025 retail sales will show a decline of 7 to 9%, representing a loss of 40 to 50,000 unit sales globally. North America will show Q4 declines of 7 to 9%, indicating the core market is deteriorating faster. Dealer inventory will remain stubbornly high at 50,000 units or more because closures offset natural sales and Harley kept shipping bikes to protect corporate revenue. HDMC revenue will decline slightly or be flat year over year for Q4 despite modest shipment growth, indicating revenue per unit declined from pricing pressure. HDMC operating margin will compress to 13 to 15% for Q4, down from peak margins in the mid-20s during the boom years, showing tariffs and deleverage are killing profitability. Full-year HDMC operating margin will likely land around 15 to 17%, which sounds acceptable until you realize it includes the one-time HD transaction benefits, and that sustainable operating margin going forward is probably closer to 12 to 14%. Retail credit losses will continue increasing toward 3.5 to 4% annualized as customers struggle with high interest rates and economic pressure. Free cash flow for full year 2025 will likely be slightly positive but weak, maybe 100 to 300 million, far below what a company of Harley's size should generate, indicating the business isn't throwing off meaningful cash despite decent reported earnings. Harley will likely refuse to provide detailed 2026 guidance, citing ongoing tariff uncertainty and economic volatility, which is code for, we have no idea if things will get worse, and don't want to commit to numbers we'll miss. Management will spin the results positively, emphasizing that they beat lowered expectations, that they've reduced dealer inventory from peak levels, that they're taking market share in certain segments, and that 2026 model launches position them well for recovery. They'll talk about their new CEO's initiatives to improve dealer relationships and optimize inventory. They'll highlight the successful ACE transaction that generated over $1 billion in cash and reduced financial leverage. They'll emphasize continued strength in their parts and accessories business and growth in international markets. All of this will be technically true but carefully worded to obscure the underlying reality that retail demand is collapsing, dealers are dying, and the business model is broken. What management won't emphasize is that they have no solution to the demographic crisis of aging customers not being replaced by younger riders. They won't acknowledge that their pricing is unsustainable relative to value delivered and competitor offerings. They won't admit that the dealer network collapse creates a downward spiral, where reduced presence reduces sales, which forces more closures. They won't discuss that tariffs are permanent structural costs that can't be engineered away without moving production overseas, which politically they can't do. And they won't address that the 2026 lineup is fundamentally more of the same bikes that customers already weren't buying, just with new paint and minor updates. The market reaction tomorrow will depend on whether results beat, meet, or miss the low expectations that have been set. If Harley somehow delivers Q4 results that are less bad than feared, the stock could pop 5 to 10% as shorts cover and contrarian investors nibble. But that pop would be a dead cat bounce, a temporary relief rally that doesn't change the fundamental deterioration. If results meet low expectations, the stock probably trades flat to slightly down as pessimists are confirmed and optimists can't find anything to get excited about. If results miss, even lowered expectations or guidance disappoints, the stock could drop 10 to 15% as the last bulls capitulate and everyone accepts that there's no bottom in sight. Longer term, beyond tomorrow's immediate reaction, Harley's stock probably trends lower through 2026 as each subsequent quarter confirms the ongoing deterioration. The dealer closures will accelerate, the retail sales declines will continue, The inventory problem will persist, the tariff costs will compound, and eventually, probably in late 2026 or 2027, Harley will face a genuine existential crisis where they have to either radically restructure the business, seek a strategic buyer or merger, or continue slowly dying as a zombie company that stays alive but never thrives. The bull case for Harley depends entirely on an external miracle: interest rates dropping dramatically so financing becomes affordable again, tariffs getting repealed or modified so costs decline, the economy booming so discretionary spending surges, a cultural shift that makes cruisers cool to young riders again. None of these miracles are likely in the near term. Interest rates aren't dropping meaningfully in 2026. Tariffs are Trump administration policy and won't change while he's president. The economy faces ongoing uncertainty with inflation, geopolitical tensions, and election year volatility. And cultural trends take decades to shift. You can't make Harleys cool to 25-year-olds through marketing when they've spent their entire lives associating Harleys with their grandparents. The realistic case is that Harley continues declining slowly through 2026 and 2027. Annual retail sales will probably drop to 160 to 180,000 units globally by end of 2026, down from over 200,000 at peak. The dealer network will consolidate to 400 to 500 dealers in North America by end of 2027. Market share will continue eroding to Indian, Japanese brands, and European manufacturers. Profitability will compress as volume declines create manufacturing deleverage and force more incentive spending. Cash flow will weaken to the point where the dividend becomes questionable. And eventually, probably by 2028, Harley will be forced into a major restructuring that includes plant closures, significant workforce reductions, exiting international markets, and potentially selling iconic brands or assets to raise cash. This isn't the outcome anyone wants. Harley-Davidson is an American icon with a 120-plus year history and enormous cultural significance. But brand heritage doesn't pay bills or create customers. Harley failed to evolve when they had the chance. They relied on baby boomer nostalgia and brand loyalty rather than innovating and attracting new customers. They prioritized short-term profits and shareholder returns rather than long-term sustainability. They built an unsustainable dealer network based on boom-era assumptions. And now they're paying the price as all those decisions come home to roost simultaneously. Tomorrow's Q4 2025 earnings will be another chapter in this slow-motion collapse. The numbers will be bad, the outlook will be uncertain, the stock will probably decline. And nothing management says will change the fundamental reality that Harley-Davidson's business model is broken and they don't have a viable plan to fix it. If you own Harley stock, tomorrow's probably a good time to sell whatever bounce you get because the long-term trajectory is down. If you own a Harley motorcycle, tomorrow is a reminder to make contingency plans for service and parts because your local dealer might not survive 2026. If you work for Harley or a Harley dealer, tomorrow is confirmation that your job security is questionable and you should be networking and updating your resume. And if you're considering buying a Harley, tomorrow's results should make you seriously question whether you want to invest $25,000 to $40,000 in a motorcycle from a company whose dealer network is collapsing and whose long-term viability is uncertain. What happens to your bike's resale value if Harley goes bankrupt or exits the market? What happens to parts availability and service access if dealers keep closing? What happens to warranty coverage if Harley restructures? These are real questions with no good answers that you need to consider before making a major purchase from a distressed company. Tomorrow morning, we'll have all the data. Check back after the earnings release and conference call for our full breakdown of the actual numbers and what they mean. Drop a comment tomorrow after you see the results and tell us whether they were better or worse than you expected. And if you're a Harley employee or dealer with insider knowledge of what's really happening, reach out anonymously because we want to tell the real story that corporate PR won't. If this preview of tomorrow's earnings disaster opened your eyes to how bad things really are at Harley, hit like and subscribe because we'll be covering the quarterly results and the ongoing collapse with analysis you won't get anywhere else. We'll see you tomorrow with the brutal reality of Harley's 2025 performance and what it means for 2026 and beyond.